Ladies and gentlemen, welcome back to the channel. Tesla stock had a pretty rough day today, down about 3.5%. Not your ideal day if you think about CPI came in lower than expected. Why was that not a positive for Tesla? And I'll just spill the beans right from the start of this video. It is very possible that tomorrow's retail sales data was in fact leaked in some way. And why I'm speculating that this could be a possibility is because when you take a look at stocks like Tesla, you take a look at consumer cyclical companies that are cyclical to the economy, they all sold off big time today. Tesla is just the obvious one that we follow every day and are heavily invested in, but it was a lot of other companies. Whereas at the same time, you actually seen big tech get a lot of the inflows. Quite a few big tech names did much better than the broader markets and magnitudes better than Tesla. So there was the classical kind of flight to safety in big tech, because if we do go into a recession, big tech is more, quote, recession resilient. So investors pull their capital into those stocks, they short other companies. And this is strange to see on a day where CPI came in better than expected, but actually kind of normal to see on a day before a major economic data release, especially if that data release is going to come in bad. And there's a possibility of that, a strong possibility of that, in fact. I've found there is some correlation between durable goods orders and retail sales. Now, last month, for the month of June, durable goods orders came in at negative 6.6%. Retail sales came in at 0%. But perhaps that suggests there could be a larger slowdown in retail sales in the data that we get tomorrow. Take a look at context for retail sales January of 2024. You came in at negative 1.1%. What did durable goods orders do? Negative 6.9%. Right? So last time we were negative by this much, you actually seen retail sales come in negative 1%. So based on this correlation, it would suggest that retail sales come in low tomorrow morning. Now, retail sales month over month are expected to actually be positive 0.3%. So I think expectations are too high for retail sales. Even if we come in at 0%, that's not going to be terrible, because you're still, it's neutral, right? Nothing's happening. You're not expanding. You're not contracting. But it still would be a lot lower than the 0.3% growth estimate that Wall Street currently has. As I have said now here on this channel for multiple days in a row, going back to last week, Thursday was always the big day of this week. Tomorrow was the big day. CPI didn't matter. PPI didn't matter. Other company earnings did not matter. Thursday was the day that matters. And I think that holds true even now to an even stronger degree. As I mentioned previously here in the last video, you got rejected at this 50-day moving average today on the S&P. What tends to happen when you get rejected at the 50-day moving average is you do tend to fall. Now, it doesn't always have to be super dramatic like you've seen back in April 29th. From the moment you got rejected on the 50-day moving average, over the next couple of days, you fell about 2%. Okay, the time before that where you got rejected was during the correction of late last year. On October 17th, you got rejected on the penny of the 50-day moving average. And what happened? You ended up falling about 7%. So some instances are going to be a little bit more extreme than this. And the reason the 50-day moving average is so important is because algorithms trade based off of this, and human traders trade based off of this. So if you get rejected at the 50-day moving average, the next major moving average you have to the downside is that 100-day moving average. We could actually go ahead and slap on here the 20-day moving average as well, because some people do like to pay close attention to the 20-day moving average as well. I don't know what the heck just happened there, But let's go ahead and slap that on, make the line, let's say white, just so we can see it pretty well. And that moving average is down here at about 539, which would be about $4 a downside from here. That would be on a percent basis, about 0.67% lower. So if you did not hold support at that 20-day moving average, then potentially you're setting yourself up for larger downside to about 530 on the SPY, which would be that 100-day moving average, down about 2.5% from here. Now, let me tell you right now, tomorrow was always the most important day. You have retail sales. You also have initial jobless claims. If, let's say, retail sales come in negative, and let's say initial jobless claims come in higher than expected, you're going to have a very rough day tomorrow. Initial jobless claims are expected at 235,000. But let's say, theoretically, retail sales come in at negative 1%. And let's say initial jobless claims go up moderately to 240,000, 245,000. I think you have a 3% red day tomorrow. I think that's how important this data is, and the markets are just latching on to any new information they can about the economy and about the consumer. Now, on the other side of this, what about earnings? Because as I have said many times as well now over the last couple of days, the only earnings that really matters at this point is Walmart. Now, I know NVIDIA reports earnings August 28th, but we kind of already know what to expect from NVIDIA. We've heard a lot of other semiconductors, hyperscalers. We've heard a lot of guidance from manufacturers like TSMC. We kind of have a good idea of what NVIDIA is going to say. They're not going to say the roof is caving in on them, that, demand is drastically slowing down. They're going to give us a so-so quarter. They're going to give us some things we like, some things we don't like, and I think that's pretty well priced into NVIDIA at this point, especially if we do get a little bit of selling, before then and now, before they report earnings. Really, Walmart is the important one coming tomorrow. And that's basically it for this earnings season. Now, Walmart back in 2007 really sparked a lot of fears about the consumer and about a potential recession. Coincidentally, Q2 of 2007, in August, when Walmart reported earnings, they had negative things to say about the consumer, that the consumer was not getting better, that they were switching down even more and just, cutting cost everywhere they could. And that's when Wall Street started to really pay attention to the recession dynamics, because Walmart is the company that, knows the most about the consumer. Walmart, credit card companies, okay, these are big bellwethers to the economy. And I think Walmart's going to be treated as such coming tomorrow morning. So let's say you have retail sales negative 1%, initial jobless claims come in a little bit higher than expected. Let's say you have Walmart that has negative things to say about the consumer. You're looking at, again, at least a 3% down day, but it could be even more extreme than that. I think going from where we are in the markets, not pricing in any chance of a recession, just judging off of 2025 earnings estimates for 2025 for the S&P are still at the highest levels they've ever been at. They're still sitting at about $280 of expected EPS next year. They're not down at all. Even though the S&P fell 10%, earnings expectations did not move, okay? With a, growing odds of a recession, you see earnings estimates fall anywhere from 5 to 10%, okay? If we were to fall 5 to 10% for earnings estimates, we would still be positive for next year compared to this year, but that would be a big decline from where we are now, expecting about 15% growth to EPS. So basically, the point I'm making is the economic outlook, the state of the consumer will directly impact earnings estimates. As the consumer gets weaker, earnings estimates will come down for 2025, and that is pen to paper material downside for stocks. Now, judging off of those 2025 EPS estimates still being where they are, there is no recession risk priced into markets. But if we start to get some bad data, which perhaps retail sales, we could get some bad data tomorrow, and judging how markets reacted to it, that's kind of what markets are saying as well. Tesla being down, consumer cyclicals being down, some big tech names outperforming. It's kind of a pretty clear sign that you could definitely see some weakness in retail sales. But nonetheless, you're going to slap the markets again with some recession fears, and markets are going to have to rapidly start pricing in or at least acknowledging there could be a recession. And with so much gains out there, with stocks that have done so well, and people that are still really not rushing into our markets, that could create a period of very low liquidity, a vortex of liquidity, if you will. And you may not see a lot of buyers step in until prices are substantially lower in markets. Now, this is just one data point, and there's going to be more to come. So it really depends how severe a potential negative number for retail sales is. Like, let's say if we get a negative 5% retail sales number, all bets are off. We could have a circuit breaker tomorrow. Okay, is that likely? No. Is it likely we come in negative based on my checks, based on what I see? Yes. But how negative is it? How bad is it? If it's not that bad, let's say we come in at 0.1%, we're still positive, we miss estimates, but it's still positive, then I would expect stocks are going to have a down 0.5%, maybe 1% kind of day, but not, the roof is caving in kind of analogy. Now, if we come in better than 0.3% month over month for retail sales, stocks are going to soar. Okay, stocks are going to go up 1% to 2% tomorrow, but I do think the risk here is downside, not upside. Think about the next 5% in markets. The next 5% upside for markets from here, if we get 5% upside, is about 570 on the SPY. That is a new all-time high, by $5, right? I just really don't see the catalyst to get us to new all-time highs at this point, even if the consumer is doing just fine. The estimates are high, right? There's not much upside from a valuation perspective in our markets. Now, yes, the Fed starts to cut rates. That's great. But what you're going to start to see happen if we do have a soft landing is just a rotation out of big tech into small caps, into mid caps that control less of the broader index. So you could actually see big tech sell off at least a little bit, the rest of the markets rally, and it really wouldn't do much for the headline S&P, kind of like the Russell 2000 massive gain that you've seen just a couple of weeks ago. It didn't do much for the headline S&P. That's because those Russell stocks, those small caps, those ones that benefit from rates going lower, don't move the needle as much for markets. Now, again, like I said, 5% lower for the S&P right now would put you back to 516. The low that you hit in pre-market on August 5th was about 507. So that would still be like $8 or so, $9 or so higher than the low that we just hit recently. Like, what is more likely at this point? 5% upside, 5% downside? It's clearly 5% downside with the growing risks that we have. And I think that's the problem heading into tomorrow after the bounce that we have seen, also testing that 50-day moving average and ultimately getting rejected around that level multiple times today. Now, again, I think the read through is pretty simple for Tesla as well. Retail sales that come in better than expected, a massive positive for Tesla. Retail sales that come in slightly worse than expected, negative for Tesla, but not a big deal. Retail sales that come in really bad is really bad for Tesla and really bad for the broader market. Now, retail sales tomorrow will also move around the odds of a 50 basis point cut or a 25 basis point cut coming September 18th. Current odds stand at 64% for a 25 basis point cut and 36% chance of a 50 basis point cut. So right now, markets are only pricing in a 25 basis point cut. Now, Liz Young Thomas says, while Q2 earnings results were stronger than expected, consensus now expects S&P 500 EPS growth of just 5.4% year over year in Q3, down from the July 10th estimate of 7.6%. The following few quarters also saw revisions lower, and this was true for large and small cap companies. The Kobisi letter is reporting that small businesses are in a recession. Small business loan availability just dropped to its lowest level in nearly 11 years. The pace of the decline is similar to the pace seen in 2007, just before the financial crisis hit. Similar weakness also took place in 1989 before the 1990 recession. In the past, such a rapid decrease in small business loan availability coincided with a spike in initial jobless claims. The current trend implies that the number of people filing for unemployment benefits could double and exceed 400,000 per week. Small businesses are struggling. Mike Wilson also says, get your bear suits on and defense on the field. 5,000 to 5,400 through year end. No better, no worse until policy decisions are made. But, and he got a big old but, equity risk premium has spiked, helping valuation arguments. It's also being reported that corporate insiders did not buy the dip as stocks were starting to fall here in recent days. In fact, they just became sellers. We do have some pretty funny news from Elon Musk. Elon Musk says if Trump is up for it, he'll dance with him for a campaign video. Like in real life, dance for a campaign video. Specifically for Tesla, as I mentioned in the last video today, you had William Stein with Truist Securities that maintained his $215 price target on Tesla with a hold rating. Actually came out with a note on Tesla today. He said, quote, we continue to argue that Tesla's AI efforts are significant to the stock, including at the current price, said Truist Securities analyst William Stein, who reiterated his hold rating and $215 price target on the group despite its recent share slump. Stein argues that while investors know that the majority of Tesla's current revenue and profit come from auto sales and increasingly energy capture and storage, that side of the business represents only around a third of its value. Based on our current estimates, which we do not see as particularly conservative, we view these businesses as worth $267 billion or $75 per share, Stein said. That's only about 35% of our Tesla price target. He also notes that Elon wants to compete with NVIDIA. He says, quote, we are going to double down on Dojo, and we do see a path to being competitive with NVIDIA with Dojo, Musk told investors last month. And we think we kind of have no choice because the demand for NVIDIA is so high, and it's obviously their obligation essentially to raise the price of graphics processing units to whatever the market will bear, which is very high. So I think we've really got to make Dojo work, and we will. So I really think the next week or two, if you will, is really going to be dictated by tomorrow morning's retail sales data, because it's all about the economy right now. And if the economy is not doing well, if the consumer is not doing well, then it's hard, very hard to make the argument that stocks should do well here. And I think there will be a direct correlation from this point on between the economy and stocks. So I think that is your most critical catalyst of this week. And I've been saying this for multiple days. And again, just judging how Tesla stock performed today relative to the S&P or other stocks as well. Tesla's obviously the one of the most obvious consumer cyclical companies, also interest rate sensitive companies. So Tesla's, I think, a pretty good barometer of this, but other stocks also did not do well that would stand to lose out the most if the economy does take a turn for the worst. So I think we need to be vigilant of this. Let me know your thoughts down below in the comment section. I do lean towards more of a negative retail sales report, but hey, it's also possible that I'm wrong, that it just comes in a little bit lower than expected, or hell, comes in a lot better than expected. Who honestly knows? Let me know your thoughts down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a great rest of your day, and I will see you in the next one.